Welcome to This Explainer. Today, we are going to completely shatter some of those conventional, emotionally driven financial myths we all hear. And instead, we're going to build a cohesive survival guide based entirely on cold, hard math. You know, most of what you hear about money out there is really just designed to sell you a product or, frankly, keep you clicking. So we're pushing all that noise aside to look strictly at the numbers, the historical data, and the real architectural rules of money. Let's get into it.
All right, here is our roadmap for today. We're breaking this down into 3 parts. Act 1 is the foundation, Act 2 is the engine, and Act 3 is survival. So let's jump right into Act 1, the foundation. This is all about structuring your money right out of the gate. Now, how you structure your money honestly matters way more than your gross income. A high income with a broken foundation is really just a bigger river flowing straight out your front door. And nowhere is that more obvious than in housing. When you buy a house, banks will happily approve you for loans that eat up to 43% of your gross income. But the real mathematical safety limit, that's actually 30 to 35% of your net take-home pay. See, the bank isn't calculating your groceries, your childcare, or your future. They just want to sell you a loan. If you follow their math, yeah, you might get the house, but you're going to be quietly drowning in it. And that's because that 35% net budget gets gobbled up rapidly by hidden costs. Property taxes and insurance leave a shockingly small slice for the actual mortgage itself. Plus, if you don't budget at least 1% of your home's value every single year for a maintenance reserve, you are basically pretending that roofs and water heaters last forever. Once you see the true baked-in costs of taxes, insurance, and upkeep, your actual budget for the mortgage shrinks pretty dramatically. Okay, so once your housing math is correct, you've got to deploy your money through this precise, optimal financial ladder. You start with a small starter emergency fund just to create a quick firewall. Then you move up step by step. Skipping ahead to invest while you're sitting on, say, 20% credit card debt is a total mathematical illusion. You are losing way more to interest than you could ever possibly hope to gain in the market. You have to do this in order. And listen, the absolute most crucial point here is step 2 of that ladder, the employer match. An employer match of 50 cents on the dollar gives you an instantaneous, guaranteed 50% return on your money before the stock market even opens. Billions of dollars in employer matching funds go unclaimed every single year, which is literally turning down free money. I mean, no stock or real estate deal anywhere will reliably give you an immediate return like this with zero risk. You absolutely must capture this. Looking a bit further up the ladder, we hit the classic choice, paying taxes later in a traditional 401k versus paying taxes now in a Roth IRA. This one decision basically determines whether you or the government captures your decades of compounded growth. If you believe taxes are going to be higher in the future, and hey, looking at the current national debt, a lot of analysts see structural pressures for exactly that. A Roth IRA gives you total immunity from that specific uncertainty. You pay the tax now, and your money grows completely tax-free forever. All right, moving on to Act 2, the engine. We've got the foundation laid. Now it's time to actually grow that wealth. With a secure foundation, we rely entirely on time and averages to do the heavy lifting for us. This is the exact moment your money stops being a river that you just consume and starts becoming a reservoir that actually sets you free. Now, human intuition expects money to grow like a staircase, right? But compounding is actually a ski jump. A lower return held for a longer time absolutely crushes a higher return held briefly. Think about it. $10,000 at a massive 12% return for 20 years grows to about $96,000. But that exact same money at a boring 7%, just left alone for 40 years, grows to almost $150,000. Time compounds so much harder than money does. Now here is where it gets really interesting. Check out the historical data. Consistently investing at market all-time highs actually produces higher average returns than holding your cash waiting for a dip. I know, our brains absolutely scream at us that investing at a peak is dangerous, but historically, all-time highs cluster tightly together during really strong bull markets. So while you sit in cash waiting for a 10% drop, the market usually just keeps moving higher and it totally leaves you behind. And because the market's best days cluster so tightly during volatile periods, usually right after crashes, waiting around for a safe entry point almost always guarantees you miss the recovery entirely. Missing just the 10 best days over 2 decades destroys more than half your wealth. Half! You can't time those days. You just have to be in the seat when they happen. Okay, Prepare yourself for a frankly mind-blowing statistic. Over nearly a century, the entire net wealth creation of the US stock market was driven by just 4% of stocks. 4%. The other 96%, they performed about as well as safe, boring treasury bills. So if you're out there picking stocks randomly, there's a 96% chance you are completely missing the monumental gains that actually drive the entire market upward.
And this reveals the exact mathematical reason why passive indexing beats active stock picking. You do not need the impossible skill of finding that 4% needle if you just buy the entire haystack. When you buy a broad index fund, you mathematically guarantee that you own that small handful of massive winners. Sure, it isn't glamorous, but hey, it's exactly how Warren Buffett won a $1 million bet against Wall Street hedge funds. Finally, let's zoom out to Act 3, survival. Because none of this matters if you lose it all. Long-term wealth isn't just about maximizing your gains, guys. It is entirely about making sure you never go to zero. If you don't survive the bad years, the good years won't matter at all. The math of losses curves violently against you. A 50% loss requires a 100% gain just to get back to the starting line. This is exactly why destructive leverage is your greatest enemy. Leverage multiplies gains, yes, but it multiplies losses equally. If you are highly leveraged and the market suddenly drops, you aren't just down. You are wiped out, forced to sell at the absolute bottom, and permanently locked out of the recovery. And this human tendency to over-leverage, it builds right into these crazy cyclical financial manias. Across generations, the actual assets change, but the reflexivity of the crowd, mistakenly buying overpriced assets just because everybody else is, that remains exactly the same. Whether it's the 1929 shoeshine boy giving stock tips, the 1999 cab driver going all in on dot-com startups, or the 2006 waitress holding 3 condo mortgages, people start asking, what will someone else pay for this tomorrow, instead of asking, what is this actually worth? And the people who get hurt the most, it's always just ordinary folks following the crowd into a bubble. Now, beyond human psychology, you really have to understand the boring, invisible, global bond market. Political advisor James Carville famously joked that if reincarnation was real, he wanted to come back as the bond market so he could intimidate everybody. And honestly, he was dead right. The bond market is the puppet master that dictates the cost of every single mortgage, business loan, and government deficit on Earth. Stocks get the flashy headlines, for sure, but bonds run the world. When bond yields rise, borrowing gets expensive, credit tightens up, and the entire economy feels the weight. And when this yield curve inverts, it mathematically suffocates bank lending. In fact, it has successfully predicted every single U.S. recession since 1955. An inverted yield curve just means investors are so absolutely terrified of the near-term future that they rush to lock up their money for 30 years just to feel safe. It is the ultimate dashboard warning light for the global economy. So let's tie this all together. By adhering to these unshakable mathematical rules, you can completely ignore the noisy financial media and safely convert your daily labor income into lifelong equity. Stick to net income housing math. Climb the financial ladder sequentially. Let time do the heavy lifting for you. Index your investments, strictly manage your risk to avoid ever going to zero, and above all else, refuse to follow the mania of the crowd. So I'm going to leave you with this final thought to really scrutinize your own portfolio today. When you look at the assets people are most excited about right now, are your financial decisions anchored on the cold reality of math? Or are you just the latest participant in a historical cycle of mania? Take a hard look at where your money is right now. Protect your foundation, fuel your engine, and ensure you survive the cycles. Thanks so much for joining me on this explainer, and I'll patch you next time.